So today we are going to discuss about the capital structure. Capital structure meaning in any organization, you have to, whenever you start any organization, there are certain stages in which the company has to go through. Whether it is a public company or a private company, those stages has to go through. Number one, whenever you form the company, the promoters have to initiate, have to take the decision to start a company. And the initial people who start the companies are the promoters. The promoters gather the shareholders and they make the required documentations like memorandum of association, article of association. They make the preliminary contracts with many people and everything. Then that stage is called the promotion stage. Okay? And once the promotion stage is crossed, all the requisite documents should be given into the registrar. And once registrar identifies that, he would see the name, okay, the appropriation of the name you have selected, that should not be too resembled to the existing name. For example, you cannot use Reliance, you cannot use Tatas, you cannot use those names because it is too resembled to other names. And also, there should not be any unreasonable names like UNO you cannot use. Okay? International organizations names you cannot use. That is called unreasonable names. Once he identifies the correctness of the names and he is putting the documentations, that article of association, memorandum of association, and all the requisite documents have been filed with him and the required fee has been paid at that point of time. He'll give 1 month notice that if there are any objection to that, any person can file the objection for the registration. So after the expiry of the 1 month, those people, the registrar of the companies will register it, and that stage is called the registration stage. The third stage, first stage was a promotion stage, second stage is a registration stage, third stage is a capital subscription stage. In case of the capital subscription stage, the company must have come into existence. The company is different from its shareholders. Okay? The company is created by law and it is going to wind up only by law. Nobody can do that. Even all the shareholders are died, or expired, or resigned, then also company will be existing. So once the company is registered, the company should need the financial support to finance its projects. Like the projects, like they have to buy the fixed assets, they have to buy the raw materials, they have to invest into land and building. All the requisite amount they needed to finance their assets, so they should think of how to raise the finance. So while raising the finance, they would decide that what shall we do? Should we go only by issuing the equity shares, or should we go for the debt? Either the shares or the debt. Generally, the new companies will go for the shares. And the existing companies, they have the option either to go with the shares or the debentures or the debt. So shares can be split into two parts. One is the equity shares, the other one is the preference shares. And the debt can be a loan, bank loan, it can be a debentures, it can be a bond, or anything else. Okay? Or it could be sister concerns financing it, or buddy financing it, or you are collecting the common pool from the general public. All these things comes under the debt. This is the third stage. And the fourth stage is the actual business commencement stage. You have the money, you have the infrastructure, you have everything, now start the business. Start manufacturing process if it is a manufacturing company. Start manufacturing, selling, and earn the profit. If at all it is a service company, provide the service, start getting the revenue part of it. So that is the business commencement stage. But this capital structure which we are going to discuss today, we are in the third stage. For the new companies. So in the capital structure, a capital structure is nothing but it's a mix of the various sources of finance. How do you finance your assets? Like the one I have told you earlier, you would finance the assets, you would finance the projects based on either the shares or the debt. So equity shares, preference shares, debentures, bank loan, all these things are the various sources of finance. You need to decide that which source you are going to, or any one of the source or any combination of these sources. For example, 50% I would go with the equity, another 50% I go for the debentures, as well as I would go for the preference shares. Or 90% equity shares, 10% debt. So depending on your requirement, depending on the market condition, depending on the company's financial viability, and all these factors should be taken into consideration before raising the finance. Why? It's a mix. What are the mix you will have in your capital structure? Whenever you decide a capital structure, that what kind of, from where you raise your finance, there are three important things which are very important to take into consideration. Number one is the cost of the finance. Number two, control. Number three, risk. Cost of the finance means if at all you issue the equity shares, it is very costly. Every time you have to pay the dividend. Every year you have to pay the dividend. It is a very costly source. The whole lifetime of the company, if you decided to pay the dividend, you have to pay the dividend every year. Then, control. If you issue the equity shares, the control will be with you. The control will not be diluted. For example, we are started a company, and we are only the shareholders here. All the shareholders belong to us. That is only 90% of the shares are belong to us, 10% taken by somebody else. Then we can be the directors of the company. We can frame the policies which is beneficial to the company. We can take the projects which are beneficial to us. Correct? Because we are the directors of the company. Suppose you issue another 10,000 shares we issue another 10,000, then what will happen? The new shareholders comes in. New shareholders once comes in, we will be in minority. Correct? The existing shareholders will be in minority. The new person will contest for the directorship. They will become the managing director. They will change the policies. They will not invest in the projects which we identified. They might change it, and we will end up in loss. So that's how the control of the company we will use. If you issue the equity shares, the control will not be. If you issue the equity, more and more equity shares, the control will be lost. Risk. If you issue equity shares, there is no risk. That means the equity shareholder cannot come and ask you, please pay back the money. No. You have to return his money or the equity shareholder's money only in case of the liquidation, only in case of the company's closing down. Otherwise, during the lifetime of the company, you need not to return the money. So, risk-wise, you are safe. Now come to the another source of finance, that is the debt, whether it's a debenture or the bond. If you wanted to go with that, then there is cost-wise, it is less costlier than the equity. Why? Because you have to pay the interest, and that interest, on the interest you can get the exemption of income tax. You have the tax shield, you can save that money. Second one is that the control wise, the debenture holders are, if you take the bank loan, then they cannot involve into the voting process. So control will be intact. There is no problem with the control part of it. Risk, yes, there is a risk. At any point of time after the expiry of the period, The bank person or the debenture holders will knock your door and ask for to return their money. If you do not have at that point of time all the money you have invested, we do not have the money either to pay back the interest or the principal amount, they can take the legal action, they can sue you. So risk is always associated with that. So very importantly here, you need to take into account whenever you are sourcing the finance for your assets, you need to be very careful that whether you need to go for the equity shares, preference shares, or the debt. Debt can be classified into debentures and bank loans. Okay? You need to be really careful that what capital structure you want to have. Once you decide that what is the capital structure you would like to go for it, then you need to know that how to plan the capital structure. There are several steps. How do you plan the capital structure? How much I need? I need 1 lakh or 1 crore of rupees. You need to plan it. While planning it, it is this way. That assessing the financial needs, that what are the assets you need? Do you need land and building? Do you need machinery? Do you need furniture? Do you need any other? Just list it. Budget. That is one aspect. Okay? Evaluate the options. Once you plan for it, then evaluate the financial options. If you are existing company or the new company. So whether you go with this equity financing or the debt financing. I just now explained that what are the advantages and disadvantages if you go with the equity, and what are the advantages and disadvantages you go with the debt financing. You know that. So whether you go with the equity or the debt or combination of this, you decide. That is the second step in the plan. You do it. Then the third step is the analyze the cost of capital, which is a very costly source. Do I need to go with the equity by paying the high dividend to them, or should I go with the bank loan? You decide it depending on the financial position of the organization, financial worthiness of yours. If you have a lot of money, don't go with the equity. If you do not have the enough resources, then go with it. That's how it is. Then after that, they consider the risk factor. What are the risk factors you are having? The market conditions, how it is, in which projects you are going to invest in, whether the marketing condition is good, credit worthiness of that particular organization is good, what are the various governance part of it, what are the various SEBI guidelines we have, all these things you need to study. Then only you can invest. Then regulatory compliance. You need to follow the Companies Act 2013. Earlier it was 1956, now it is repealed. It is 2013. So 2013, you should know that how much you need to pay the dividend. Before paying the dividend, you need to transfer certain amount to the reserves. So how much is that? You have to follow that. And how many directors you have to appoint? Are you following that governance part of it? And the sitting fees of the directors you need to decide. Then arm's length contract. See, I am the director of the company. I have my relative or the cousin. I have given a good project of the company to make the profit to receive the company to that person. That is called the arm's length transaction. You need to be very careful with respect to arm's length transactions. Then you need to sit there. Then you need to follow the SEBI guidelines while issuing the shares, debentures. If within 90 days, if you don't get your required money, within 120 days after the expiry of the 90 days, you need to return back the money. So, all the regulatory compliance needs to be observed and discussed. So one can say that what is in the capital structure, what would be the optimum capital structure? Exact, optimum in the sense, exact, approximately, a good capital structure. What? Whether should I go 50% equity, 25% debt, 25% preference? This would be the optimal, or 50% equity, 50% debt is optimal. Nobody knows it. Nobody will give you a tailor-made solution. That whether what is optimal? You need to decide in your organization by taking the stock of your financial resources, how sound you are, or how much money you require. You need to decide that how much you need to raise and through the what source. If you are having the idle cash with you, you are not investing, then it's better to go with the equity part of it. If you are not sound, if you are a new company, you have to go for the equity. If you are an existing company, then perhaps you can go for the debt. You can use other people's money into your organization. That is called trading on equity, financial leverage. Other people's money you are using within your organization. Now, whenever you go for the debt, whether it is a bank loan or the debenture, you need to be very careful that you need to work out the internal rate of return. That your internal rate of return, the company's internal rate of return should be more than whatever the interest rates the bank is charging you if you go for the bank loan. For example, if the bank is charging 10%, you take the at 10%, but you should be able to earn at 15% or 20%. So your internal rate of return should be more than the interest rate which is being charged to you. Otherwise, it's a waste. The bank is charging you 10% and you are running at 5%, 5% is a loss. So, internal rate of return, you need to work it out for your organization. You need to decide that how and what quantum and what source you need to get the money. Okay? Then the optimal capital structure will be decided. There are a broad spectrums, broad parameters have been given. To certain extent we can decide, but again it is a subjective. Capital structure is a subjective to the organization. The organization has to decide that what would be done completely. But a broad spectrum has been given. You need to find out that what is the weighted average cost of capital. We have the problems, we are going to work it out now. Weighted average cost of capital, we have done it, right? So, whenever any person asks you that what is your weighted cost of capital, you cannot say that my equity share capital cost is this much, my preference share capital cost is 5%, my debenture interest is 10%, you cannot say that. What you have to do, you have to club it, you have to average it, you have to tell us my weighted average cost of capital is 10%, 5%, 8%, 12%, in combination of all these things. That is one of the factors you need, or the step you need to follow. Then balancing tax benefit and the financial risk. Balancing tax benefit and financial risks. You need to take the maximum out of the tax. For example, if you are opening your company in the free trade zones, under section 10A and 10B of the Income Tax Act, there are certain tax holidays for you. 10 years you need not to pay the tax. So government has given that in order to promote the industry, promote the employability, promote the employment, this kind of the schemes that they give. And if you go for the equity, then you have to pay 100% tax. If you go for the debt, on interest whatever you pay, you need not to pay the tax. That is a tax exemption that you need to take care of. Okay, financial risk. If you go for the more and more debt into your capital mix, then it is more and more risk that you need to repay back. You will have the tax benefit, but it is a financial leverage which we are going to do the problems, which decide that higher will be the financial leverage, higher will be the risk. That is the second step we use. Maintaining financial flexibility. You need to be more flexible. You should not be rigid. No, I'll go for equity. No. Only I'll go for the debt. Don't do that. So depending on the project which you are financing, depending on your requirement, availability, the resources you have, you decide that whether you want to give it the control, then issue the equity. If you don't want to give the control to the others, then go for debt. But at the same time, you need to decide that your internal rate of return should be more than the weighted cost of capital. If it is a weighted cost of capital is 10%, you should be able to earn at 15% or more. Okay? Then, aligning with the business strategy. What is my business strategy? I'm a manufacturing company. My business strategy is a manufacturing company. I'm a manufacturing company. I cannot go indulge into the financing. I cannot go on financing thing. So, whatever the source you wanted to plan, as per the goal and aim in the business strategy of your organization, it should be aligned.